Good afternoon. This problem is basic and diluted earnings per share. This problem is a lot like exercise 1914 on page 1186 of Spiceland's 7th edition Intermediate Accounting, but there's more requirements here. I think you'll find it more comprehensive. First, because it's not the same problem, let's consider the facts in this problem. On December 31st, 2013, there were 200,000 shares of common stock. Now you might want to write all this stuff down. Just scribble it or put it in scrap paper so that you can refer back to it without having to replay the video. On December 31st, 2013, there are 3,000 shares of $100 par value preferred cumulative stock paying dividends at 9%. Now remember, cumulative means that even if no dividends are paid this year, they're accumulated and paid the next time dividends are paid. Now, on March 1st, 2014, the Connor Steel Company repurchased 24,000 of its own shares. And this is what the chapter refers to as treasury stock. On July 1st, 2014, Connor issued a 5% common stock dividend. This is a stock dividend, not a cash dividend. On October 1st, 2014, the Connor Corporation resold 4,000 treasury shares. And net income on December 31st, 2014 was $15 million. Now here's some more facts that you should keep in mind as we do the problem. First, we're assuming that there's a 25% tax rate. That's common with these problems, is that the companies will pay some income tax. Also, the company granted incentive stock options in 2013. An incentive stock option means that key employees can buy shares for a certain strike price or option price in 2014 or after. $40 was the 12/31/13 price, and that's how much in this problem key employees can pay for additional shares of stock. During 2014, between January 1st and December 31st, the average market price of the stock was $50. So, if you're trying to figure out what we mean here by an incentive, what's the incentive? Well, if you expect stock to rise, as this company did, or the stock price to rise, as this company did at the end of 2013, you can say, key employees, you can buy the shares for stock price at the end of the day, December 31st, 2013, and because it's rising, like in this case it rose $10 a share to $50, actually the $10 difference between the price you pay and the value you get is the incentive. So what's required in this problem is we're going to calculate basic earnings per share, and sometimes this is referred to as primary earnings per share because that was the old title. And then also we're going to compute diluted earnings per share, and I've written here fully diluted because that was the old term for diluted. Let's think for a minute about what these terms mean. Well, basic earnings per share is the simple one. This is just earnings per share as those shares are out there now. Diluted earnings per share considers how low earnings per share could be if all the potential shares are issued. Now this problem is remarkably simple. There's just a few options. Consider a complicated common stock structure where there might be significant options. There might also be convertible preferred stock. These kind of things could actually cause a great difference between basic earnings per share now and what diluted earnings per share would be if everybody exercised their option and converted their preferred stock. First, let's consider the net income minus the preferred dividend. We're going to see that this is a significant part of the earnings per share calculation, and it's going to be the same for basic or diluted earnings per share. So remember that taxable income was $15 million and the tax rate was 25%. So if you multiply 25% by the $15 million, you get $3,750,000, and $11,250,000 turns out to be net income net of tax. All right, we have to calculate the preferred dividends because they're cumulative. We don't care if they're actually paid or not. So there were 3,000 preferred shares. Each share sells for $100. The dividends are 9%. So we're thinking the preferred dividends could be $27,000. So what we do is take net income, $11,250,000, subtract $27,000 from this, and we've got net income less preferred dividends of $11,223,000. Now, whether we do the basic method or the diluted method, this will be the numerator. So it's the denominator that changes depending on the dilution. So first let's consider the basic weighted average number of shares. So for the full year we had the 200,000 shares. That's going to be involved in the calculation. But then the company repurchased 24,000 shares, but they only did it on February 1st. So that reduction was not for the full year. It was only for 10 of 12 months. So we're not going to subtract a full 24,000. We're just going to subtract 20,000. Then there was a stock dividend. So the stock dividend is 5% of the outstanding shares. Well, as of the date of the stock dividend, there was the 200,000 shares minus the full 24,000 that had been placed into the treasury, because the stock dividend is not given on the shares in treasury. Then we multiply that number by 5%, and then we take the whole number and multiply it by 1/2 of the year. So it would have come out to be $8,800 for the stock dividend. And you see that I had that on there and then I crossed it out. But since we only had the stock dividend, only had the additional shares for the last half of the year, we treat that in the weighted average number of shares calculation as half of the 8,800, or 4,400. Then the reissued treasury shares, we reissued 4,000, but only for the last quarter of the year. So for the weighted average number of shares calculation, we treat that as 1,000 new shares. So then we just did the math, and when we subtracted the 20,000 and added the other items, we came up with the weighted average number of shares, 185,400. So the basic earnings per share calculation is remarkably easy. At this point, we have 11,223,000 in the numerator, 185,400 on the denominator, and a basic earnings per share of $60.53. Now let's think about the dilution. And I told you in this simple problem, the dilution only occurs from the options. So remember, the strike price, and that's standard financial terminology, the strike price or the exercise price of the option is $40. The average market price is $50. Now, when we're trying to decide whether these are dilutable or not, We have to consider whether the strike price is less than or greater than the market price. In this case, the market price is higher, so we would expect people to exercise the options. They are dilutive. So the process we go through is to multiply the number of options, which were 100 in the problem, times $40 per option. That gave us $4,000. We divide that by the average market price of $50 per share. AMP here stands for average market price. And this means that we believe we would have to repurchase 80 shares in treasury stock to satisfy the options. So here's the diluted weighted average number of shares calculation, much as we did before. So I'm not going to go through that all again. The shares for the full year are the same. The shares that were repurchased for treasury are the same. The stock dividend is the same. The reissued treasury shares are the same. However, now we have 20 new shares coming from options. And the way we did that is if all the options were exercised, there would be 100 new shares. We expect we would have to repurchase 80 through the treasury. So we wind up with 20 new shares. And the last calculation showed you how we got the 80. This means the diluted weighted average number of shares is 185,420. So we plug the weighted average number of shares for the diluted earnings per share into the denominator. The numerator is the same, and we get $60.52. Now, we had virtually no dilution because this was a simple problem. But notice, even in this simple problem, the diluted earnings per share are $60.52. The basic earnings per share is $60.53. If we had greater dilution, a larger number of options issued for multiple previous years, let's say there were options for 2011, 2012, and 2013, that still could be exercised. Also, if we had a lot of convertible bonds, we might have a significant difference between diluted earnings per share and basic earnings per share. Something else about the difference between this problem and something you might see in real life. Although this is realistic for a privately held company that doesn't have very much stock, if it's a large public company we're talking about, quite possibly the diluted and basic earnings per share would be smaller. In other words, there's likely to be more shares outstanding. Hopefully this has answered your questions about the difference between basic and diluted earnings per share and given you a simple example of how to calculate it. Give me a call or text me if you have any questions, or certainly contact me by email. Good luck working your problems in this chapter.